Good morning. If you don't have yourself on mute at this time and have your video on your end turned off, please do so at this time. If you have any questions during the program, please enter them into the chat feature or hold them until the end of the presentation. And if we run out of the time to address questions, at the end of the program, on the final slide, you will find my contact information, and I'll be happy to talk with you after this program today. I'd like to start by introducing myself. My name is Jenny Hendrickson, and I am an attorney in the corporate team here at Davis & Kuelthau. And as a business law firm, we offer innovative legal solutions to private and individual clients that range from small, mid-sized institutions to large corporations. Our team here helps family and closely held businesses mitigate risk relative to regulatory, litigation, and transactional challenges that arise daily. My practice specifically focuses on business and estate planning, which includes employer benefits, tax, business real estate, probate, and trust administration. So today I will be presenting on tax, liquidity, and other wealth management in the era of COVID. Previously, don't worry, if you signed up for tax strategies for an unprecedented year, you are still in the right place. We had just a title change. So nonetheless, we are going to start off with tax and COVID-19. Can't imagine a much more exciting topic or one that you might want to run from. But thanks for joining me. Let's dig in. From the onset, Congress, the President, SBA, IRS, and Treasury Department have all been busy either creating legislation or interpreting it ever since COVID-19 showed up. The goal or intention of all this legislation has been to assist businesses, employers like you during the pandemic. So there's been a plethora of information and guidance regarding PPP, COVID legislation, the tax credits, tax deferral, but the sheer volume of this information we have found has been confusing for many people instead of helpful when you as a business are trying to determine how to utilize PPP funds or what the various tax credits and deferral opportunities are best for you and how you can best utilize them for the financial stability and success of your company. So here what we're going to do is go over at a high level the opportunities that are available depending on your business circumstances. So for businesses who did not obtain PPP funds, the Paycheck Protection Program loan, the tax deferral and tax credits portion of our discussion today will be of particular interest for you. So if, like me, you are a racing enthusiast, and in particular for me, it's Formula One and performance cars, you will understand some of my jargon through here. So we are going to start in the pole position. So first spot on the grid, if you can imagine and think way back to March, we had Families First Corona Response Act first passed on March 18th. This is the act that gave businesses tax credits. The refundable credits that you as an employer, if you have fewer than 500 employees, are a reimbursement. It's meant to give you cash in your business. So dollar for dollar for you for the cost of providing COVID-19 related sick and family leave wages, along with qualified health plan expenses and your share of the employer Medicare tax imposed on those wages. So these refundable credits are applied against your payroll taxes. Again, it's cash that stays in your business. The credit means that you don't have to, as a business, deposit those funds that you would otherwise be required to do so. Also, as the employer, you are not subject to the employer portion of the Social Security tax that would typically be imposed for those wages. So again, when I'm saying wages here, what I'm referring to are the COVID-19 related sick and family wages. Now, as an employer, here's where it's really crucial to be working with an advisor who is looking at your cash flow. Because what you want to make certain of is when you are looking at your business tax liability, you want to be reconciling whether or not the refundable credit that is owed to you dollar for dollar is more than your tax liability. And if it is more in your quarterly filing, so this is an analysis you're doing when you're completing your 941 or your 943, if your tax liability is less than what you can receive from the refundable credit, then it's important that you are also filing Form 7200 with the IRS along with your quarterly report. Form 7200 is very simple. It's a one-page document, 8 lines, and that's what's going to give you an advance payment for the refundable credits that are owed to you. So that document, right on the face of it, at the bottom of that form, is a fax number. You want to fax that off right away to the IRS so that you can receive additional cash flow into your business for these refundable credits. So now also with this 7200, that form, it cannot be amended. So if you find that in your calculations you've made a mistake or there's a correction to be made, you will make that up in your next quarterly filing, or you can also, by the way, handle the advanced credit through the end of the year 944 filing. Now you probably don't want to wait that long because the idea here is to get as much cash into the business as you can each quarter. Now keep in mind, what is very important through all of this as a business when it comes to the tax opportunities with these pieces of legislation is you need to know your numbers, you need to know your dates. For these wages that you may be paying, it is wages from April 1 to December 31st of 2020. So keep that in mind. And remember, they're the qualified wages paid due to a COVID-19 sick and family leave expense. Now, just an aside here. So for some businesses who haven't been required to make that payment because they fall into the small business exception, we have found that there are some businesses who are still paying out that leave. Reason why they're doing is they're finding that it may be beneficial to their workforce to decide to pay it, and because of the dollar for dollar refundable credit that they're able to take, it makes sense from an employer perspective for them to offer this benefit, if you will, to their workforce. So that is also something that you'll want to keep in mind if you are falling into the small business exception. Okay, next. In our second spot on the grid at the start of the race, we've got our next piece of legislation. You no doubt have heard this term over and over again in the last several months, CARES Act. The CARES Act gave us the employer payroll tax deferral. That's what I want to talk with you about next. So in order to, again, free up cash flow to businesses, the CARES Act here has allowed employers to defer the employer portion of payroll taxes. That's your 6.2% due for wages paid. Now, here's again, take note, we have a different time frame when you are able to use the wages for this deferral. It's a March 27th to December 31st for 2020. The wages that you're deferring, those are not going to come due until the following year. The first 50% of those deferred payroll taxes are due December 31 of 2020. The second half, or the remainder of your deferred payroll taxes, those will be due at the end of 2022. So also keep in mind, the payroll tax deferral can be used if you received PPP funds. This is important because not all of the opportunities from a tax perspective are available to you as a business if you have received PPP funds. Up next, our number 3 spot at the starting line of our race, we've got another CARES Act opportunity. This involves the employee retention credit that you have available to you as a business. So if you received PPP funds as a business, here you'll want to sit back because this part of the tax opportunities is not available to you. For those who haven't received PPP funds, let's talk about what this opportunity presents for you. As a business, there are 2 ways that you qualify for this retention credit. And remember, the reason for this legislation is for you as a business to retain your employees. So the first way that you qualify for this credit is that if you are a business that has either fully or partially suspended your operations as a result of a COVID-19 order and continue to pay wages, or second, if you are a business that has had a 50% decline in your gross receipts as compared to 2019 as a result of COVID-19 related order and you're continuing to pay employees. That gets you the ability to have this employee retention credit. Keep in mind, if you are qualifying because you have had the reduction in the gross receipts, if at any time in a quarter your gross receipts recover up to 80%, then you won't be able to obtain this credit. But when you have a decline again, should that happen in any quarter, you will be able to qualify and receive the dollar for dollar ERC, as it's called, credit. So here again, it's dollar for dollar against qualified wages. This is a different time frame, March 12th through December 31st. So keep that in mind again, that is your time. Yeah, they are. There is a cap for you as far as what you're able to take for this credit. There's a maximum of 50% on $10,000 of wages paid per employee. So what that really means is $5,000 you are keeping in the business per employee for this particular credit. Now in the analysis, if you're finding that you have more out versus the credit, you will use Form 7200 in order to have that advance of the refundable credit. The rules will differ for you. If you are an employer that has more than 100 employees, or you are an employer with fewer than 100 employees. For less than 100 employees in your business, if you have less, it's for all wages. If it's a business that you have with more than 100 employees, it will be for the qualified wages. So the ERC and the payroll deferral, they provide you with those tax credits in the year 2020. And then you've got the deferral, that tax payment that will actually end up needing to be paid. That portion of your payroll taxes is deferred until the end of 2021, and then the other half 2022. Again, keeping cash in the business. Let's look at an example. So here we have an example of how the refundable credit will work when you have paid wages for that COVID-19 leave. And this, as I've noted at the bottom, is one of the examples that the IRS has given us guidance. And here in this example, we have a business who has paid $10,000 in qualified sick leave wages and qualified family leave wages in their Q3 of 2020. Remember, as a business, you don't owe the employer share of Social Security tax on the $10,000, but you still will owe $145 in this example for the employer's share of the Medicare tax. Your refundable credit is equal to the total, the $10,145. That's the $10,000 in qualified leave wages plus $145 of your employer's share of the Medicare tax. This amount, the $10,145, is applied against your federal employment taxes that you're liable for in that Q3. You do, as a reminder, still must pay, what you must do is withhold the employee's share of the Social Security and Medicare taxes on those qualified leave wages. Okay, next up, in our fourth spot on the racing grid, we've got another CARES Act, the PPP loans. Here we're going to talk about the PPP loans as well as its forgiveness and then its taxability to you as a business. So the CARES Act, we just talked about the employee retention credit. Two programs were given to us, two completely separate opportunities. With the CARES Act, we were also provided the PPP loans. They are mutually exclusive. It's an incentive to you as a business to keep your employees rather than furloughing them and rehiring. As you no doubt know, if you've received these funds, it's a potentially forgivable loan. In contrast, the ERC credit that we just talked about is a credit. It's cash that you already have that you keep in your business. To prevent employers from double dipping, the CARES Act prohibits an employer from receiving the PPP loan and from claiming the employer retention credit. Most businesses have chosen to apply for the PPP loan even though they don't have the ability to claim the ERC credit, but it is definitely an analysis, if you have not applied for those funds yet, that you should go through and decide whether or not it makes more sense for you as a business to have the PPP loan funds or to have the ERC credit and keep that cash in your business. PPP loan forgiveness. So the CARES Act gave us the SBA guaranteed loans. Under the program, you have the opportunity for that loan to be forgiven. You must use those funds for qualifying costs over your covered period. Initially, it was 8 weeks. It's been extended to 24 weeks. The date this begins, and again, remember I said in the beginning, the dates are important. Track the dates, track the calendar. Here, your covered period begins on the date you receive your funds. You must use those funds for the qualified expenses. Initially, it meant 75% for payroll costs. Now it's been lowered to 60% for payroll costs. You can use it for more than that 60%, but you must utilize it for 60%, or we won't get to the forgiveness part of the value of this loan. Your payroll costs include health insurance, retirement pay, in addition to how you must use the funds and when you must use the funds. Keep in mind that there's an employee count and employee wages factors that must be satisfied. That's outside the scope of what we're going to cover right now, but keep that in mind to talk with your advisors about. So The other part of what the CARES Act gave us is, okay, as a business, you have these loans, you've used the funds during the covered period, and you're using it for the qualified expenses. Now, you're able to apply for the forgiveness, and that application has been made available. If you need it, we can certainly get that to you, or your lender can get it to you. What happens next with taxation? In the CARES Act, it specifically stated that those funds are not to be included as income to the business for federal income tax purposes. What we saw come later from the IRS is a notice that told us that you are not able to deduct expenses that you are using those funds for. So essentially what's happened with that IRS notice is that the IRS has eliminated the tax benefit for the PPP loan forgiveness. Typically as a business, you would, on your business tax return, wages, for example, would be a deduction. But if you're paying those wages out of your funds from the PPP loan, you are not able to use that as a deduction. In some cases, that means that the tax bill may actually be higher. Now, right now, there are several bills in Congress, and in fact, the HEROES Act is one of them. It gained some traction last night where they are hoping to rectify this outcome and overturn the effect of the IRS notice. Because again, the intent of this program was to assist businesses, and increasing your tax bill would not be the outcome that they are hoping for. All right, next up, strategies for long term. So while the spirit of the PPP program is to give you, as the employer, the means to keep as many employees employed as long as possible during the COVID crisis, in some circumstances where we are finding that employers are not able to maintain their pre-COVID-19 workforce. There's been a change with the orders coming in or delay in orders. It's not going to be an all or nothing with the PPP loans and their forgiveness. So by way of example, a construction business is a good example where they have their funds and they may have now found that they are unable to keep their hourly employees. So they've had an issue with their orders or a delay. What you want to look at as a business is that this loan, you can use a portion of it and have a portion forgiven. And the other part that you may not be able to use and qualify for forgiveness, it may be a smart strategy to convert it to a loan. Now, initially, the loan was set at 2 years. It's been increased, so it's a 5-year loan at 1% interest. And that might actually be a long-term strategy for you in the business environment to consider. Maybe you actually want to choose to use some of those funds for a reason that doesn't qualify you for its forgiveness. Keep that in mind. It's important to run the strategies. In some situations, it may be a better strategy to help enhance loan, to use your loans for additional contributions to 401k or to bonuses in order to meet your 60% threshold for payroll. Keep those items in mind. We want you to always be balancing the various strategies to enhance your long-term economic stability. Now, what happens when Uncle Sam comes knocking? It's important for you to audit-proof your business when the IRS comes knocking for potential audit. What does this mean? Get organized now, retain your documentation for a 4-year period, and what should you be holding? You should be holding your payroll tax filings, you should be holding your reports, the count for your employees' head count, individual salary information, the canceled checks, your mortgage payments, your lease payments, everything that you have that coincides with how you have used funds or why you have taken credits. Maintain this documentation in an organized way, do it from the beginning, and you will be set to have a smooth transition when the IRS comes to review how you have used these funds and how you have taken your credits or the deferral and the amount of your deferral of payroll taxes and how you chose to take the first 50% at the end of 2021 and then the remainder at the end of 2022. So putting all that together, what we hope is in this environment where everything seems to be changing weekly, if not perhaps daily, is that these give you some ideas on how as a business you can manage and control the financial situation by keeping cash in the business and staying economically stable. I only have a few minutes, it looks, and I haven't even had a chance to get to your questions. But what I want to do is just quickly mention to you one concept. Interest rates are at an extraordinarily low level in today's environment. If you are a family-owned business or closely held business, you probably have promissory notes on the books. Looking at those promissory notes and refinancing them with the low interest rates that we have right now may be beneficial to you as a business to get some cash influx into the business while helping the borrower perhaps extend their payments by giving them a longer time frame. You can always add in additional terms to secure that note with collateral security agreements or having a default interest rate that's higher. This is just one way to think about how can we creatively use opportunities we have today to keep and add cash flow to the business. Well, it looks like I have reached my end and I didn't have the opportunity to get to our last topic. I thank you though for joining me today. If you have questions or would like to talk about any of these opportunities further, please contact me at either of the phone numbers on the final slide or through my email address. Thank you so much. Take care and be well.